I'm here today with Carl Goldfischer from Bay City Capital, Managing Director out in their West Coast office. Welcome. Thanks for joining us.
Nice to be here.
So why don't you take a moment and tell us about Bay City and where the firm is these days?
So Bay City is a life science investment firm based in California. Actually, Bay City is named after my partner's hometown in Michigan. It has nothing to do with San Francisco. And we've been around for almost over 15 years now. I've been there since 2000. Across five funds, and we've deployed $1.7 billion almost exclusively in life science investing, with pretty good returns overall over that time period. We basically do everything. We do very high concept seed startup companies. We also do middle level clinical development, and we do late stage development. We buy public stocks, we do convertible debt, we do restructurings of companies. So it's a pretty soup to nuts operation. We have approximately 25 professionals, we'll call it, both full-time and in our orbit. We have a firm located in Shanghai that's a affiliated firm. One of our partners just relocated to Zurich to work in Europe for us. We have work going on in emerging markets ranging from the Middle East to other parts of Asia, and more in South America and India. So that's what we do.
And has the evolution of the firm changed in recent years in terms of the types of investments you're making or the types of therapeutic areas you're looking at?
Sure. Yeah. We, like most venture firms, have focused much less the past few years on cardiovascular, metabolic disease, et cetera, just because that's been an incredibly difficult space for us to generate adequate returns in. And I'll talk a little more about how we're approaching that in a couple of minutes. We do a lot of cancer, a lot of orphan disease, just things that there are shorter times to liquidity, things that the public markets are more receptive to. The other thing we've done in the last few years is we have a pretty bipolar investment strategy. So we've basically focused on some companies where we are the first money into the company. You know, we either started ourselves, we're in the first rounds, et cetera, or we're trying to figure out how to be the last money in before a liquidity event. Sometimes you don't get that right, but there's very little in the middle. So it's either very, very early, or stuff that's pre-approval, post-approval, launched, et cetera, not very much in the middle the last couple of years.
What makes working in the middle so hard?
It's been impossible, nearly impossible to get the entry points right. So let's say you figure out a company, and we've had this happen a couple times, where there's a phase 3 trial going on in an area, the trial is concluded successfully, okay? But they mess up the regulatory filings, right? So just normal, it goes through 2 or 3 cycles of review. So that basically puts an extra year or two, in the path to approval, and then that means more capital is required, and it's just very hard to get that right. So we either try and be, as I said, last or the first.
Got it.
I mean, some of the big things that have changed lately. There's a lot more, obviously, market acceptance of early stage biotech companies again. So in the last couple of years, I'd say 18 months, there's obviously a really bull market for a lot of what we do. There have been innumerable IPOs, a lot of trade sales. We actually had a sale of one of our companies yesterday. We have a company called Epizyme that went public last year and has doubled since then. So there's a lot more acceptance of what's going on among public investors. Even at the same time, there's much less institutional money going into healthcare venture.
Your new fund that you're raising focuses on partnerships with strategic investors from big pharma and biotech. What caused the shift, and why do you think that's a promising route?
So a few years ago, in looking at the landscape, we had a couple of thoughts. The first that I just described is that the returns on early stage life science investing for the previous decade have been very poor. And as such, the universe of investors for that kind of work has shrunk probably 50%. So an endowment like Columbia's endowment, whatever their allocation was to work like ours, it's much lower now than it was pre-2008. So you had fewer dollars going into the space. Also, as I'm sure you've all seen, there's been a pretty significant restructuring in the pharmaceutical business. They also found that their huge investments in pure research we're not generating the returns on investment that their shareholders demand. So that's why you've seen over the past few years, most pharmaceutical companies lay off literally thousands of researchers, cut back, close facilities, cut back on research spend, and at the same time they increase the dividend and buy back stock with the proceeds, and their stocks go up, and that's how the managers get paid, and it's all. So what we saw is that might create what we'll call an innovation gap. Like, how do you replenish these pipelines? So if you have people like us with fewer pools of capital to invest, and you have most of the larger pharmaceutical companies also cutting back their research expense, then there's going to be a pipeline gap. So we came up with an idea of a fund that we're calling an innovation fund that will close in the next little while. And that's a fund that's largely going to have strategic partners as the limited partners in the fund. So we have, right now, Celgene has committed $50 million to the fund. There's a company that I can't name today that has interest in cardiovascular metabolic disease. They've committed a similar amount of capital. So the idea is that from the beginning, basically we're going to sort of build these companies to be sold to the buyers, right? And those buyers are going to be partners of ours from the beginning. So that's what the fund is about. And so it's devoted to early stage life science investing across several disciplines. And then the hopeful trick is that if you start it with the buyer around the table, right, then when you get to reasonable points of execution, the buyers can want to take it and put it into their clinical plan. That's the idea.
Okay. Prior to coming to Bay City, you were the CFO at InClone. And so to many of the graduate students leaving the university are trying to plot their own course and would no doubt love to follow in your path. What do you see as the challenges of either beginning your career in investor or beginning your career in a large company?
Yeah, so that's really interesting questions. So I'm a physician by training. I went to medical school in the Bronx in the 80s. My training was in radiation oncology. I left clinical medicine in the early 90s. And in the early 90s, which is 20 years ago, there were many fewer MDs and PhDs who wanted to leave medicine or basic science to go work in investment banks and companies. There just wasn't as much of it. Now, obviously, it's a much different world. So at that time, it was actually relatively easy to get a job, and I got a job in an investment bank doing some work, and then I worked for an insurance company as an analyst, and then, as you said, I became the CFO of a publicly traded oncology company called InClone. And when I became the CFO, they had just started the phase 1 trials with Erbitux, and it was clear that it was an active agent. And it's hard probably for the people listening to remember 20 years ago, antibodies to treat cancer, this was not, as common. I mean, this was still, Herceptin was just in clinical trials. There just wasn't a lot of it, so it was considered pretty groundbreaking work. And there were signs in the phase 1 trial that in EGFR positive tumors, particularly head and neck, you'd see these massive sloughing of tumors and these really interesting responses in end-stage patients. And so I was attracted to the company because, frankly, the data looked intriguing and it seemed like the drug would ultimately be approved. Right? Now, back then, it was also possible to become CFO of a public company without any formal accounting training. This is all pre-Sarbanes-Oxley, and so a lot of my job there was helping fundraise and etc. And while I was there, the company grew tenfold or something like that. And ultimately, obviously, a lot of things happened, but the drug was approved and still sells a couple $1 billion a year. It's hard exactly to know what to make as pure recommendations for someone who's a scientist or a physician interested in business, right? I think if you're interested in business, going to medical school first is probably not the best use of 10 years of your life, or getting a PhD, right? I think you go into those fields because you want to be a doctor or a physician, or you want to be a scientist, not because you want to do business on the side, because there's just more efficient ways to do that. However, if you're there and you're not exactly sure what you want to do, right, there is nothing like getting operational experience, before coming to, even if you think you want to be an investor or whatever you might want to think about, I think the first step would be going to work for a company. And if you can get a job in a larger pharmaceutical company, those are still the best training grounds, even with all the cutbacks that we've described. It's one of those pedigree kind of things that if you spend a few years in one of those companies, it just helps you do whatever else you want to do in your life.
So a lot has been said about the changes in New York, and especially in early stage technology investing in New York over the last 5-10 years. I'm curious for your perspective as someone who's from New York and has spent a good chunk of your career on the West Coast. Where do you see the future of New York City and other clusters that are trying to compete with the strongholds of Boston and the Bay Area?
Yeah, that's a really great, very interesting question. So my father, who's a physician, was the dean at Albert Einstein in the 80s, and he started the first technology transfer department there. And his dream was always to try and build a biotechnology park out by Einstein, and there was no support politically for doing something like that. Right? So my interest in New York and how you transfer technology from from the universities into some kind of biotech hub, but really goes back a long time. And when I worked at Inclone, it was Sam's credit, the only biotechnology company in New York, right? And so seeing what is the transformation that's going on in the last few years is very, very exciting, and it's I think it's really just beginning. I mean, obviously with Alexandria building the now second building on 29th Street, you've got lab space going up, right? Every university, whether it's Cornell, Memorial, are much more focused on technology transfer and creating more of an entrepreneurial climate for this kind of work than has existed before in New York, which has always been frustrating, right? Because here you have the greatest financial center in the world, but nowhere near that kind of ambiance, right? Now, and as you may know, that New York City has received $100 million from GE, Lilly, and Celgene, that they're trying to come up with a matching program really to fund startup companies in New York. And
that's the early stage life sciences fund?
Right, yeah. And we're talking to them about it, and we'll see how we participate or not. But however it plays out, I think you're going to see an absolute resurgence of startups in the field going on over the next 10 years. And it's probably going to, remember Pfizer was started in Brooklyn, right, on Henry Street, and they don't own the building anymore, but it's some going back to that kind of roots, and I think it's really, really exciting, So.
Well, thank you so much for joining us today. I really appreciate it.
My pleasure. Thanks for your time.